All right. Now, having understood what is equity, what is debt, and what is a share, let us try and understand something about shareholders, shareholding, and the capital structure of a company. All right. So, in the previous lesson, we have seen that those five friends wanted to buy a pizza. Now, their ambitions have grown, and let us say that they want to start a garment manufacturing company, and the requirement of money to start that company is $20 million. All right, they want to start such a company which requires $20 million. So what they do, they contribute whatever each one has got, their lifetime savings, they contribute, and they come up with $10 million. All right, somebody pulls in 1 million, somebody pulls in 2, somebody 3, and together they are able to manage $10 million. The requirement is 20, so they are still short of $10 million. What will they do now? What they do is, these people so far who were calling themselves as friends, now they call themselves as promoters, and they formulate a company, a notional company, not actually notional, but on paper they establish a company, and they call that company Five Friend Garments Limited. They can call it anything. Let us say that they call the company as Five Friend Garments Limited, and they become the promoters of these company. Promoters means the people who have started or are starting this company. All right. Now, this company, Five Friend Garments Limited, this company will approach the bank and ask for a loan for the remaining $10 million. All right, then they have been able to manage for the remaining money. The promoters cannot ask the bank. The promoters, of course, since the company cannot walk up to the bank, the promoters will go to the bank on behalf of the company, but the loan will be asked by the company or for the company. All right, and the bank will see the collateral guarantee. The bank will ask the promoters what collateral guarantee can the company give, and the promoters will say we have got a small piece of land, we can place that as a guarantee. So the bank says, okay, we can offer you a maximum of $2 million as loan, as debt, not more than that, and you will have to pay us 10% interest on this amount. So they accepted, okay, let us manage 2 million more. Now they are still short of $8 million. All right, their requirement was 20, 10 they have been able to manage, 2 they have taken as loan from the bank, still short of $8 million. So what do they do now? They come up with an idea. As they had done for the pizza, what they do now, they divide the entire company into 1.8 million shares of $10 each. All right, this company which is still on paper, they are dividing it into 1.8 million small pieces, each piece costing $10. Why 1.8 million? Because remember, we had talked about that the share has to be first of all equal and then distributable. All right, since they want $18 million, 10 they have already been able to manage, they want 8 more, so the requirement is $18 million. Therefore they divide it into 1.8 million shares, each share costing $10. All right, and they ask the public. Before they ask the public, they themselves pick up the shares depending upon how much they have contributed, each of them. The person who has contributed $1 million will pick up 0.1 million shares. The person who has contributed $3 million will pick up 0.3 million shares, and so on. All right. So a total of 1 million shares are picked up by the promoters themselves. Why 1 million shares? Because together they have contributed 10 million. So 1 million shares they pick up. And now they invite the public. They ask the public that whoever can pay $100 can take 10 shares of our company, and you also become a stakeholder in our company. All right, so 0.8 million shares are available for the public to take. Anybody can take those shares, just pay minimum of $100 and pick up 10 shares of this company. All right, and then they become a stakeholder. There is no difference between the promoters and the public shareholders, except that the promoters are having a larger number of shares. The people or individuals who are buying from the public, they may have a small number of shares. That's all. But otherwise, in terms of each share, everybody is equal. Okay. Now, you see, we talk about the capital structure of the company. So we know that 2 million is the debt. This they have borrowed from the bank, and the remaining 18 million is the equity. Out of this 18 million, 10 is with the promoters and 8 is with the public. But the entire amount is equity. As I have told you, there is no difference in the equity held by the promoters or the equity held by the public. It is one and the same. So 2 million debt, 18 million as equity. The total capital of the company is now 20 million. They can make the company function now. They can build up the infrastructure, purchase the machines, start their work. All right. Now there is something called as the debt equity ratio. Debt is 2 million, equity is 18 million. So the debt equity ratio of this company, Five Friend Garments Limited, is 1:9. All right. Just imagine if the debt was 5 million instead of 2 million, if the debt was 5 million and equity was 15 million, then the debt equity ratio would have been 1:3. And another scenario, let us imagine that the debt was 10 million and equity was also 10 million, half. All right. In that case, the debt and equity would have been equal, 1:1. What is the significance of this debt and equity? That we have discussed in one of our other courses, which is about the fundamentals of finance, investment and business. I have explained in detail over there. But this debt equity ratio basically signifies the risk being carried by the company. As we proceed in this course, we will also touch upon this further. All right. Now, there is something called as the shareholding of the company. We know that the public now is holding 0.8 million shares and the promoters are holding 1 million shares. All right. So promoters are holding more shares. The public are holding lesser number of shares. So out of the total 1.8 million shares of the face value $10 each, 1 million are held by the promoters. That means the promoters are holding 55.6% of the shares. They have a majority shareholding. The promoters have got a majority shareholding. And the public have got 44.4% of the shares. It is not necessary that the promoters have more than 50% of the shares. The promoters can have less number of shares also. But the point is that the promoters have started the company. They want to retain the control of the company. All right. Therefore, a good promoter will always try to retain more than 50% of the shares so that they retain the control of the company. All right. Now, try and understand this. Very important. Please recollect who has borrowed the debt of $2 million. Have the promoters borrowed that money or the company has borrowed that money from the bank? Just think over. The money has been borrowed by the company, not by the promoters. So, whose responsibility is it now to return that money? This debt has to be paid back by the company, Five Friend Garments Limited, and not the promoters. The promoters have not taken this loan or the debt. It is the company which has taken the debt. All right. Please remember always, as long as you want to be in the stock market, always remember that the company, the owners of the company, and the management of the company, all three of them are separate entities. They are not one and the same. The company is an entity in itself which has borrowed the money. All right. Owners of the company, these promoters and the shareholders together, that public who are holding 0.8 million shares and these promoters who are holding 1 million shares. Together, they are the owners of the company. All right. Together, they are the owners. Each shareholder, even if he's holding one share, 1 out of 1.8 million stake he has got in the company. So even if you are having one share, you can still call yourself as a very, very, very small owner of the company. The owners of the company can participate in the management. They can become board of directors. Since the promoters have got lot many shares, they can become part of the management. They can become board of directors. But still, the ownership and the management will remain separate. All right. So now the shareholders are entitled to receive the profit. If the company generates profit, the shareholders are entitled to receive the profit in the same equitable and distributable amount. All right. Whatever, the share of the profit the promoters will receive, the same amount the other shareholders will also receive the same equitable amount per share. All right. But the shareholders, including the promoters, they are not liable to repay the debt. This $2 million which has been borrowed from the bank, the shareholders are not liable to return that debt. Shareholders means, again I repeat, the promoters as well as the public who are holding the shares. So these people are not responsible to repay the debt. Who is responsible? It is the company which is responsible to repay the debt. The company will earn profit. Out of that profit, the company will pay the interest on the debt or return the debt. And then the balance profit which remains belongs to the shareholders. All right. So the company will give profit only after paying all the dues and taxes. Dues means the interest on this borrowed amount, and any other person who is entitled to receive the money, who has lent the money to the company, they will first receive the money, the government will receive the taxes, and then the profit which remains belongs to the shareholders, the promoters and the public shareholders both. All right. How the profit is generated, how the tax and debt is paid, how the shareholders get their dividend, all these aspects are important for you to understand if you have to remain in the stock market. And all these things we shall be discussing as we progress. All right.